Welcome to Enlightened Wealth Strategies, the podcast where insight and knowledge meet opportunity. Please join us as we navigate the world of finance, discovering actionable strategies to help you achieve your personal financial goals.
With decades of combined experience, we're here to shed light on the topics that matter most to your financial well-being. Whether you're accumulating, preserving, or distributing your wealth, this is the place for you.
Now let's dive in and start your journey to financial enlightenment. Well, Jack, we want to welcome you. You are a member of Sumner Equity, and you're going to be here with us, Jim Lombardo, who is my colleague and co-host of the Enlightened Wealth Strategies podcast. So we're looking forward to discussing a lot of different issues and concerns related to the equity and markets to close out the year, and also what to expect in the upcoming year, especially after the post-election results. So before we get started, perhaps you can tell us a little bit about what it is that you do.
Well, I guess in a nutshell, we're balanced portfolio managers. So we're dealing with clients both on equity and fixed income basis, and we're managing discretionary assets, liquid assets for people. From a sort of our investment approach, we're fundamental investors. We're very much value driven, and if there's anything unique about what we do, we try to really create personalized portfolios. I know James, you've had a lot of experience with working with us and what we do in that regard. So we're not creating cookie cutter portfolios, but we're trying to create portfolios that make sense given the needs and sort of the constraints of each of our clients.
Exactly. Yes, I've had a lot of experience with working with Jack, with my clients directly. But Jack, a couple of questions here. So since the election, there's been a lot of bullish sentiment. I'm sure you would agree. In fact, we've seen great highs in the S&P 500 and the Dow Jones. In fact, the S&P 500 is 50 new highs, closing highs. And the DGIA, the Dow Jones, has come close to 45,000. And same with all the other equity market. So I suppose for now, should we be following the momentum, staying with the trend, as they say, or do you see something different?
Well, we're sort of in a quandary right now. I mean, on the positive side, as you talked about, we're anticipating we're going to be seeing fairly significant tax cuts, or at least a reversion to Trump's prior policies. We're also talking about a lot of deregulation, both of which should be positive for the markets. On the other side of the coin, we're also hearing we're going to have potentially significant tariffs. We have the potential for a lot of deportation of immigrants, so that's going to have some impact on the workforce. So while the market has been pretty euphoric, we're concerned that in a sense, everything is predicated on this dramatic earnings growth, and we're not as comfortable that it's going to be as great as the markets anticipates. In the very short term, we're sort of riding the momentum, but we're also, in some cases, we're selling covered calls in sort of hedging our positions. We're also, we're struggling, especially with newer money, to find what we see as many compelling values. It's more difficult in our mind to find things that are really that attractive. So we're, I guess on the very short term, we're positive. On the longer term, we're going to take more of a look and see approach and maybe be a little more defensive, raise a little cash right now while things are great, so that we have an opportunity, if there is some sort of meaningful correction or change in momentum, that we'll be able to participate in.
Okay, well, you touched on a lot of different topics that both Jim and I do want to address. But before we even go there, perhaps you could explain a little bit about covered calls, because that's a defensive mechanism and strategy that we have used for individuals. Maybe you could just give a quick 1 minute, an explanation of that in particular.
Well, as an example, I'll use something that I did today. I decided to buy a little bit of Citicorp today. They continue to be one of the banks one of the large banks is perceived to be potentially undervalued. They're actually still selling at a discount their stated book value, and so we bought some of the shares today in the 70 range, but not being that confident that the stock is going to go straight up, we turned around and we sold some February 75 calls. So we took in a few dollars to do that. So that, in a sense, it hedges us a little bit in that if the stock goes down to 68, we're at a break even. But we're still positive on the stock. So we've given it some room to run, and hopefully, by February, it'll either be up to 75 or close to 75, in which case we'll probably roll those options. But we're basically just trying to, I guess, generate a little bit of additional revenue, as well as give ourselves some level of protection. And depending upon how we feel about the company, we may sell right at the money or sort of out of the money calls, out of the money being above the current stock price, at the money being calls that are being sold right at the stock price. So it doesn't protect a dramatic downside, but if we feel good about the stock, then it's just a way to hold it and hopefully make a little bit of money along the way with with a sort of a longer term perspective.
Okay, let's go back to the economy. I'm sure Jim has a couple of questions too.
Actually, just out of curiosity, with the momentum that's been going on in the markets, do you think a lot of that's due to the AI craze?
Well, I think some clearly does, but I also think you're seeing a broadening out of the market. People are, they're expecting earnings to grow in a lot of different categories. So, I mean, even, for example, a lot of the consumer staples, if they historically sold at, let's say a 15 to 18 price earnings multiple, a lot of those companies right now are selling at 26, 27, higher than normal multiples. The AI has driven some of it because arguably it's going to provide for, I guess, greater, trying to think of the right term, I guess efficiency among other things, potentially cutting costs. So, there are a lot of areas where AI may be able to enhance the earnings capability of companies. And the underlying AI companies themselves, the NVIDIAs and the ASMLs and, all the companies that are sort of related to either chips or software, like, for example, yesterday, Salesforce had good numbers and talked about, how much AI is going to help them in terms of their products and enhance the ability to use them. So some of the increase in price, I think, is appropriate and being driven by opportunity. But like everything else, it can get a little ahead of itself. It gets a little euphoric.
Right.
One of the things we sort of hear a lot about is American exceptionalism, and the idea that, right now the U.S. is doing everything right and the rest of the world is lagging. But when you look at the market, so much of the world's money is invested in the U.S. markets at a much higher percentage than historically has been the case, that you just wonder, is that going to last forever?
Right.
I remember back in 1987 where, things were sort of going the same way. We had all this money piling in from Europe, and one day someone blew a whistle and the market sold off dramatically.
Yeah.
It was fairly short-lived, but it was, a serious correction and quite an experience back then.
A lot of the corrections that we see are sometimes unexpected.
Yeah.
What do you see with the national GDP? What that looks like?
I'm sorry. What?
The national GDP. Yeah. What are your feelings about that? What do you perceive happening with the GDP?
I think right now I have a lot of questions. A lot of it I think is going to be a function of what happens with tariffs. Are we going to, get in a position where we're not going to be trading in the same, sort of same level with our trading partners, whether it's Canada, Mexico, China? How much is that going to change our output? I'm not an economist, and I really don't like trying to forecast those things too much. But I do question what our trade policies are going to be and what's that going to mean in terms of our output. So I hesitate to really address it.
No, that's okay. I was
well.
just trying to get a feel for it. That's all. You're right.
Yeah.
We're not economists, and it makes it difficult. But sometimes I feel the GDP, along with the unemployment numbers and all that fun stuff, come into play.
Well, I mean, I agree with you. I think, for example, right now we've got a big jobs report coming Friday, and next Wednesday we've got a big CPI report. And, both of those things I think are going to, be something that the Fed takes a close look at. Everyone's expecting a December rate cut, but, I think, Powell has indicated he's going to be looking at the data. So I'm anxious to see what happens with those reports. We're a little skeptical in terms of the direction of interest rates. We're not confident that rates are going to be coming down that dramatically. So
I would agree with you too, Jack. I think if we go back to when they initially cut rates, the market anticipated that there would be 3, 4, 5 rate cuts the remainder of the year into the new year. It doesn't seem like that's going to happen. Perhaps it's going to happen in December, but moving forward, I don't get the sense that they're going to be making these rate cuts. And I agree with you too. I think it's going to be dependent upon what this data, these numbers, what actually comes out. But as we also both know, the unemployment numbers or the labor statistics have been revised dramatically 2 and 3, 4 months later. So all this job creation that occurred during 2024, a lot of that fell by the wayside. And the other component of this that's often overlooked or maybe not even discussed is that the two bigger sectors of job creation was in two areas only: the health industry, healthcare, and government. And of course, those numbers were adjusted. So are we going to see the same thing again, even despite the fact that maybe the unemployment the labor numbers and the unemployment numbers may be good, they look good, and the Fed's going to make decisions based on that. But again, in the future, are they going to revise those downward again?
I didn't catch the last part of that, James.
No, my concern would be: are we going to see the same thing that we saw in recent months, where despite the fact that those numbers might be good, that they might be revised downward, and they're making decisions based on what they see currently, but historically over this past year, and it's happened in other years as well, but not as dramatically. I mean, these numbers that were adjusted were significant in size and scope.
Right.
Anyway, that's going to have an impact on how we do things with individuals' portfolios as well. Let's go back to the Trump administration, because you brought this up, both tariffs, deregulation, even the tax cuts. So let's see if we can unwrap a couple of those things. Tariffs, from what I understand, they're going to, what he's proposed, that he would like to impose tariffs on both Mexico and Canada. And in fact, he had a meeting with Trudeau only a couple of days ago, and basically told him, you're going to be hit with tariffs, and that we're being ripped off, as he often says, by $1 billion, And I think he actually teased him and said, if you don't like it, you could always become the 51st state and become a governor in
Right.
Canada. I don't know if you heard that.
Yeah, no, I did.
Yeah, and deregulation, I also think that's going to be a big component of it. It was in his first administration, and will there be tax cuts? I think the only thing that, from what I could see, is that he's more than likely going to extend or expand the tax legislation that occurred back in 2017. Will he be able to get anything else through? Maybe. He does have Congress behind him. But we'll see. I was just curious what your thoughts are on those three particular areas.
Well, I think we're likely to see the corporate rate come down. I think we're likely to see individual rates come down. The premise being we're going back to the whole trickle down theory, where if we create an opportunity for large corporations and individuals to be more profitable, then that revenue is going to in turn help stimulate the economy. It's going to create a larger tax base. That money is going to trickle down to the rest of the population and stimulate the economy. The question is sort of how successful that will be, and what will be the associated tax revenue. I mean, the argument is that if we lower tax rates, there's going to be this boom in the economy, and that's going to result in additional tax revenue. And then if we also, are able to impose all these tariffs, that's going to create a lot more revenue. Our new, at least potentially incoming Treasury Secretary indicates that he wants to get the federal deficit down to 3% of the GDP by 2028. I think that's pretty ambitious, and I question how likely that's really going to happen. But I mean, we really have to wait to see. I think the one thing we know about President Trump is that he likes to throw out a lot of, I guess, suggestions or rhetoric as to what he's going to do, and he sees himself as an excellent negotiator. So maybe some of this tariff talk is just positioning, and maybe it won't have the sort of the harmful or the inflationary effects that some of us are concerned about. But we have to see what and where. As an example, one of the companies that we own is Constellation Brands, which happens to generate a lot of sales through their Mexican beer. So if Mexican beer, if there's a big import tax, that's really going to hurt the economics for them. But it's sort of interesting because in that particular case, the reason that Constellation ended up owning those brands in the first place, part of the agreement was that those brands would always be manufactured in Mexico. So are we now going to see Mexican beer manufactured in the U.S.? So there's a lot of twists and turns associated to, the various, I guess, talk that we hear. And, we're just going to have to keep our eyes open and see what happens next.
Jim?
I'm actually, at this point in time, I guess one of my biggest concerns is the deficit and the growth of the government. Do you see Trump coming in and trying to slim it down?
Well, that's what Besson said he's going to do, is he's going to bring that deficit down. As I say, he says 3% by 2028, which would be spectacular. But I question the ability to do that. If we're not going to tax tips, we're not going to tax Social Security benefits, we're going to lower taxes for everyone. How is that going to lower the deficit? I mean, they're talking about eliminating or reducing a lot of government regulation and I guess the associated costs of running a government. But does that really work? I mean, I personally question it. I will say, it's going to be interesting to see how Congress reacts and whether they're going to just follow Trump's lead or whether they're, more likely to do things to try and rein in the deficit. But I think if we're not careful, the deficit could really come back and create a problem for us. Probably the worst thing, if our debt ever got downgraded, then our borrowing costs would continue to rise, and that would be that could be a real problem. So
well,
I think the deficit is something we really need to be concerned about, and I think a lot of Congress is.
Well, it's interesting you say that, though. I have statistics that I pulled up, historical data, that 1975 the national debt was 53 billion, and then 1985 it was 212 billion. I should say the annual deficit. Now it's 1.8 trillion dollars and counting, and then the national debt is 36 trillion and counting. So we should have been more concerned about it 50 years ago or 40 years ago. And it doesn't seem like Congress has ever really been concerned about it. They just keep pushing it off. To your point, though, Jack, is there going to come a time where other countries are not going to invest in our deficit? Effectively, that's what's happening. You also see it here with China. China is not buying as much as they have in the past of our treasury, and Japan is kind of picking up the slack. Do you see that as a problem going forward for the country?
I'd say yeah, absolutely. I mean, one of the things, to be candid, I was disappointed in was Yellen during her time has not done more, especially when rates are lower, of financing more of our debt with longer obligations. I think there was too much of an emphasis on the issuance of short-term versus long-term debt, and at a time when I think people were really positive about the U.S., and I think they continue to be. But if we alienate a lot of our purchasers, there's been at least talks about the BRIC countries going to their own currency, which would be
right.
Pretty bad, if not a disaster for us. Trump's response has been, well, then they wouldn't be able to trade with us, and there'd be 100% tariff. But I don't think that's going to get us anywhere. So I do think that right now the dollar continues to be strong, but as if interest rates come in, are people going to be as attracted to the U.S. to U.S. paper? And as the GDP to debt ratio gets worse, are people going to feel as comfortable buying our paper? So I think the deficit is a real consideration. The hard thing is, who wants to give up some of their income, or who doesn't want, in the case of Congress, who doesn't want to get programs into their jurisdiction? Who doesn't want federal support, federal spending? So we can say that we want to curb our expenses, and that we're serious about supporting the dollar, but are we really going to take the painful steps that we need to take to make that happen?
Yeah, that's the key. I think we'll see what they do with this. What is it, DOGE, the Department of Government Efficiency, that he's anointed Elon Musk, and I think even Ron Paul is now a member of this group. So it'll be interesting to see what they come up with. But I guess the questions that Jim and I would have is, now we'll bring you back to, we looked at it, on a microcosm or microscope of all the various things, and then looked at things on a macro basis. But bringing it back to just working with individuals in their portfolios, there's a lot of things that we obviously consider. one area that we haven't even discussed too is the impact of China, because now we mentioned tariffs, but the Chinese economy itself is also having some issues. How does that play with your decision making when it comes to investing in individuals' portfolios?
Well, I mean, as a whole, we've really, our firm has avoided any of the Chinese companies. We just don't feel comfortable. You and I talked about yesterday, James,
Mm-hmm.
The dramatic overbuilding that we've seen in China and the problems their economy is struggling with. The some of the companies that we wonder about, though, is Apple obviously has been a major beneficiary of Chinese manufacturing. So if we get into a trade war, are they going to be hurt? And some of the other companies that do a lot of business there. So we look more in terms of sort of a U.S. centric approach. We look at companies that we own or that potentially we own and wonder, to what degree are their revenues driven by China? Starbucks being another good example of a company that sees a lot of the revenue from there. We're nervous. We're nervous about the potential impact. We're trying to bring a lot of manufacturing back onshore, but that takes time. We're also seeing manufacturing being, sent or diversified into other, whether it's Vietnam or India or other places. But there are costs associated with it. So, China continues to be an important, partner of ours. And you can see that, for example, this year for the holiday inventory of a lot of the retail companies, they sort of did a lot of pre-ordering or accelerated their orders in order to make sure that they had the inventories they wanted coming from China in the event that we do get into a tariff war.
It's hard to envision. I know the international markets have been lagging compared to the U.S. The biggest, I guess the biggest concern I have is in the past, usually when the U.S. was thriving, the international markets faltered. And when U.S. wasn't doing well, the international markets picked us up. Do you see that still being the case here with regards to everything going on?
I guess right now, as I say, we continue to see this, this concept of the American exceptionalism and dollars pouring into the U.S. But I have to say, if you start to look, for example, at the large capitalization companies in Europe, there are a lot of excellent companies there that are selling at much more reasonable valuations. Also, the emerging market companies, especially if you exclude China, I think probably offer some opportunity. I think now is not a bad time to be making at least a modest shift away from some of the U.S. companies towards international. But for us, at least, we do it on a very gradual basis. We're not going to make a dramatic change, but we are looking overseas a little bit more, and think that there are probably opportunities, at least going out a ways.
Okay, Jack, we have a couple of minutes left, and we just wanted to kind of wrap up. We may have to have you come back at another time, but in summary, what should we be looking for in the early part of, I'm certainly not going to ask you to be a prognosticator, but what do you expect to see in the early part of the new year? What should we be prepared for?
Really interesting. I mean, among other things, I'm looking at my portfolios, and we have tremendous number of capital gains, and we've already realized a lot of gains. So, especially for our taxable accounts, we don't want to be selling anything more right now. But come first of the year, are people going to be realizing some of those gains? Taking some money off the table. We still have this momentum, and if you listen, I have CNBC on in the background a lot of the day, and most of the people that come on are still very positive. but there are a certain number of people who say valuations have gotten ahead of themselves. And if you believe in Warren Buffett and Berkshire Hathaway, they're accumulating billions and billions of dollars in cash. So that, that suggests that maybe we should begin to be more defensive. And is a correction in the outing. We haven't had a 10% correction in a pretty long period of time. So I'm still positive on the U.S. I don't mean to be so negative, and I also think there are sectors of the market. For example, materials have been left behind, healthcare has been left behind. So there are opportunities there, but I think I'm not euphoric at this point. I'm I guess cautiously optimistic, but I want to keep some powder dry for opportunities, depending upon what the new administration actually does, what we see, where interest rates go. If interest rates are rising, that's likely to hurt the tech and the faster growing companies, because their multiples are to a certain degree dependent upon a low interest rate environment. So lots of questions, no great answers. As you know, I'm not a very good prognosticator, but I've got my eyes open and looking.
Thank you very much for that.
I think that you summarized it with cautiously optimistic, and I think that's what we'll use going forward. We'll be a little bit more defensive in our posture. Jack, is there how could for any of the listeners, how could they find you? Obviously, they're going to find it through Jim and I, but do you have anything online that people could look to?
Well, we do have a website, but to be honest, we're not very active on it.
That's fine.
We're so you can look at our website, and it'll give you a little bit about us. But in general, I would have people talk to you guys. We're not we're really not marketing oriented. We're a small organization, and our focus is really just on investment management. And we were happy to have relationships with advisors like you that appreciate what we're trying to do and work with us and help hopefully benefit your client.
Excellent. All right. Well, thank you very much, Jack.
We appreciate your time.
Yeah, very much.
It's great to talk to you both.
Okay.
Take care.
All right. You too. Bye now.
Thank you for joining us on this episode of Enlightened Wealth Strategies. We hope you found today's discussion insightful and inspiring.
If you enjoyed this episode, don't forget to follow and subscribe to our podcast. You can find us on YouTube, Apple Podcast, Spotify, or your favorite podcast platform to stay updated on new episodes.
Your financial journey doesn't end here. Connect with us online for even more resources and exclusive content.
Until next time, remember, financial enlightenment is just an enlightened wealth strategy away. Investment advice is offered through Bell Point Asset Management, LLC, 500 Demont Ranch, Parkway Building 700, Unit 700, Reno, Nevada, 89521. Additional information about Bell Point Asset Management is available on the SEC's website at www.advisorinfo.sec.gov. It is important to read our disclosures available at this link, www.bellpointasset.com disclosures. The information provided in this presentation is educational and limited to the dissemination of general information. This material is not intended to be a recommendation of any kind, investment, tax, or accounting advice. Does not constitute a solicitation to buy, sell, or hold a security or an investment strategy. Engage in any financial transaction and is not provided in a fiduciary capacity. The information provided does not take into account the specific objectives or circumstances of any particular investor or suggest any specific course of action. Investment decisions should be made based on an investor's objectives and circumstances and in consultation with his or her financial professionals. While the advisor uses reasonable efforts to obtain information from sources believed to be reliable, the advisor makes no representation that the information or opinions contained in this material are accurate, reliable, or complete. All information and opinions contained in this material are subject to change without notice. The views and opinions expressed are for informational and educational purposes only, as of the date of the production or writing, and may change without notice at any time, based on numerous factors, such as market or other conditions, legal and regulatory developments, additional risks and uncertainties, and may not come to pass. This material may contain forward-looking information that is not purely historical in nature. Securities offered through Fortune Financial Services, Inc., member FINRA and SIPC, Bell Point Asset Management, LLC, and Fortune Financial Services, Inc. are not affiliated. Past performance is no guarantee of future results. Investing involves risk. Principal loss is possible.